What are the pros and cons of a collar option strategy? Have you ever wondered how to protect your investments while still having the chance to profit? The collar option strategy might be just what you need. This strategy involves holding a long stock position while buying a protective put option below the current stock price and selling a covered call option above it. This creates a collar that limits both potential losses and gains within a defined range. Let's break down the pros and cons of this strategy to see if it fits your trading style. First, let's talk about the advantages. One of the main benefits is risk management. The protective put limits downside risk by allowing you to sell the stock at the put strike price. This provides a safety net against sharp declines in stock value. Another plus is cost offset. When you sell the call option, you generate premium income that can help cover the cost of buying the put option. This can make the hedge cost-effective or even cost-free. The collar strategy also establishes defined outcomes. You have a clear floor, which is the put strike price, and a ceiling, which is the call strike price. This reduces uncertainty and exposure to volatility. It is particularly useful for investors holding significant shares in a single stock who want to protect against losses without selling their shares. Plus, there is flexibility in choosing strike prices and expiration dates. This allows you to tailor the balance between protection and potential gains based on your outlook and risk tolerance. Now, let's look at the downsides. One major con is limited upside potential. The short call caps your maximum profit. If the stock price rises above the call strike, the stock may be called away, preventing you from enjoying further gains. There is also complexity and management involved. This strategy requires managing multiple option legs with the same expiration, which can be more complicated than simply holding stock or buying a put. Another consideration is potential opportunity cost. If the stock rallies strongly, you might miss out on gains beyond the call strike price. Additionally, transaction costs can add up. Multiple option trades mean paying commissions and fees, which can reduce your overall returns. Lastly, the timing sensitivity of this strategy is important. The effectiveness depends on selecting appropriate strike prices and expiration dates. Poorly chosen parameters can result in inadequate protection or excessive limitation on gains. In practical stock trading, the collar strategy is often used when an investor expects moderate stock price movement or wants to protect unrealized gains while still maintaining some upside exposure. It is a balanced approach that trades off unlimited profit potential for defined risk control. So, if you are considering this strategy, weigh these pros and cons carefully to see if it aligns with your investment goals.